REITs. A REIT is a real estate investment trust, and this is where you are investing into a company that's investing into real estate investment properties. Unlike crowdfunded investments, you can invest in REITs on the stock market, so you can buy and sell REITs whenever you want. If you're subscribed to this channel, you know that I love investing in real estate. If you're not subscribed to a channel, you should probably do that, but I invest in rental properties, I have invested in crowdfunded real estate and REITs, and all of these real estate investment options have their own pros and cons. The reason that people love real estate as an investment is because you can create, for the most part, predictable passive income. You buy a property, and to keep things simple, let's say you buy a house for $100,000, and then somebody moves into this house, a tenant, and this tenant is now going to pay you $1,000 a month every month for living in your house. But buying and operating your own rental properties is a little bit more extensive because one, you need to have access to the cash to buy the property, and two, you need to have the team built. So that means you need to have access to the real estate agents and the contractors and the attorneys and the accountants and the property managers, so it's more involved. This is where REITs come in handy because you can invest in a REIT, which is a company that is now going out and investing in real estate and making money through rent. The cool thing about REITs is that they are required by law to pay out 90% of their taxable income or their rent to you, shareholders, through dividends. REITs make money by buying real estate properties and then leasing them out to other people. That way they make rent. So now they take all this rental money that they get and they pay their bills, and now they take 90% of whatever money is left and they have to pay this money out to you and other shareholders through dividends. A dividend is a cash payment that a company gives you. So now instead of you going out and getting rent from a tenant, you are investing in a company that's going to manage the property and do all the work, and this company is going to pay you a share of their profits through dividends. REITs are a popular way for you to invest your money if your goal is passive income, because REIT stocks tend to pay much higher dividends than regular stocks. Some REITs pay 10% dividends. That means if you invested $100, you will get $10 back this year just through dividends. When you invest in a high dividend paying REIT, what you'll typically see happen is that when a dividend is paid out, this is called the ex-dividend date. So when the dividend is paid out, you will typically see the stock price of the REIT fall by the amount of the dividend. So if a stock is trading for $200 a share and it pays out a $20 dividend, you will many times see the stock fall to $180 a share the day that the dividend is paid out. If it's a really strong REIT, you'll see the stock price climb back up because investors will use this dip as a buying opportunity to buy the stock. And when it comes to dividends, we have to talk about taxes. Dividends that you get from REITs are typically taxed differently than the dividends you get from regular stocks. Typically, if you go out and you buy a stock and this stock pays you a dividend, you get to pay a very low tax rate on this dividend called the long-term capital gains rate. This long-term capital gains rate is usually a lot lower than the tax rate you pay on the money you make from your job, which is called ordinary income. Well, the IRS says that you have to pay taxes a little bit differently when it comes to REITs. The government said, okay, because REITs pay out higher dividends, it's almost like another income stream for you, so we're not going to give you the long-term capital gains rate, which is a special lower tax rate. You have to pay the ordinary tax rate, which is the higher tax rate on REIT dividends. If you have an accountant or a tax software filing your taxes for you, this isn't really something that you have to worry about too much when you're filing your taxes because this should automatically be calculated. This is more something I just want you to be aware of so you understand how the tax game works. Now, I also do have to tell you that while I am an attorney, I'm not your attorney, so if you have specific tax questions, make sure you talk to a tax professional in your area. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you gotta do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.